Okay, this is lecture 6 of Velric's Black Belt Model Series. Today we're going to go through reversal signatures and how you can read them. Plus we'll also cover how the black belt can be a catalyst for high time frame moves. So this is an hourly chart, and we're looking here at an hourly BISI that we had unfilled and completely open going into the 9:30 open. Now when we're going into the 9:30 open, you have to consider a few things. Not just the pre-market range, high and low. You have to consider where are we overall drawing to on the daily time frame, the 4-hour time frame, the 1 hour time frame, the 15-minute time frame, or even where is the relative equal highs and lows on the 1 minute time frame outside the pre-market range. Because if you have the advantage here in knowing where it's going to go, that will favor you. That's a good thing. There's no sense in trading without a bias when you can trade with one. Now, of course, you won't always be able to have a bias. Sometimes the chart is going to be puzzling and it will look 50-50. And in those cases, it's okay to not use a bias and just focus on here's a pre-market low, here's a pre-market high. Is the black belt present? Yes, take a trade. No, don't take a trade. Very simple. But if we see a PDA rate to the downside, like here we have an hourly BISI, and it's 9:30, we expect a volatility injection. If we're bullish, how will it treat this BISI? Well, in either one of two ways. It's going to tap it and then run higher, or it's going to completely leave it open and fall short of it and then run higher. Either way supports bullish price action. Now, the more preferable scenario in terms of what we can capitalize on is if it reaches into the BISI, because then we can know, okay, black belt took out the pre-market low and it went into that hourly BISI. Now sometimes it will leave it open and that's okay. You just don't get in with the BISI, you get in with something else, or you don't get in at all. That's okay. If it leaves the BISI open, it's likely to have a stronger move, but what can we actually capitalize on when it reaches into the BISI? So this is that same hourly BISI at the 9:30 open. You can see price comes down and takes out the pre-market low, that's this low, and that's Velric's black belt model, sign number 1. This is the previous day PM session first presented fair value gap. You do not need every first presented fair value gap on your chart. It's beneficial, in my opinion, to have at least yesterday's, or maybe even the day before yesterday's, whichever day in the recent week that you are sharing a range with. So if it's Thursday and yesterday's first presented fair value gaps are not sharing the range with today's range, but Tuesday's ones are, go ahead and use those. These are not necessary though, they're just useful little reference points and I really like them. It reaches lower, takes out the pre-market low, and then goes into the hourly BISI. The first movement into the hourly BISI, this 1 minute candle, supported by the black belt, and supported by the hourly BISI, and supported by the fact that we're bullish high time frame going into that intermediate term high, and also these relative equal highs. There's a lot of confluence here that we should go higher. So even if you exclude the black belt and you look at this without the black belt in mind and you just think, okay, liquidity sweep runs into a discount array on a high time frame, displaces higher, the fair value gap, and then runs up into that 18th of December new day opening gap and the hourly intermediate term high. That alone is a tradable move. But the black belt in this case is just a confluence to that move. This is the catalyst, the black belt is the catalyst to that move. Now the 9:30 open will always have volatility, and it may not have even taken at the pre-market low, and it could have just gone there. And on the times that it does that, you shouldn't be there thinking, oh, I missed a move, or you shouldn't be trying to chase it. It's just as simple as, this isn't the model, I don't get in. I have to follow the rules and the structure that's been presented to me. This is how I profitably trade. Not, it's moved, how do I get in? It's moved, does my model allow me to get in? So here when we see the first movement into the hourly BISI, and there's an S&T with ES, and it immediately rejects, and it's a black belt, and we're bullish high time frame. What is this now? This is an A plus setup. There's nothing better that we can take in the market than this. Now here is the opening range gap as well. You can see it trades down to the upper quadrant. The first 2 wicks, it doesn't really breach it a lot. Third one does, which is okay because it's sell side damage, and then it rejects. So this is causing damage to the sell side and then immediate rejection. Then we have our first reversal signature. So I've gone through now how we can anticipate high time frame moves, well, the catalyst for the high time frame moves with the black belt I'm not going to go through reversal signatures. There's a lot of different PD arrays you can use, and I've covered some of them before. We have first presented fair value gaps, inversion fair value gaps, we have SMTs, we have a bunch of stuff. But when you're actually looking at what is in price action that I can look at and think, okay, it's definitely going to move into the pre-market high, or there's a high degree of probability that it should move into the pre-market high now, which is the objective of the black belt. We have an inversion fair value gap. That's the first one. Now, there's multiple, but I'm going to begin with this. When we trade through an inversion fair value gap, you want a strong closure. Anything that's a little bit above, that's no good. If it closes only slightly above, that doesn't count. Not in my eyes. If you go into your charts and you look at any type of fair value gap and it's closed above by one little tick, there's people on the internet who will tell you that's what validates it as an inversion gap. No, no, no. It doesn't. How many times do you see in charts that price trades up into a fair value gap, colors a little bit outside of it, and it's respected and then dumps? A lot. So you cannot get faked out with just a one tick closure above the inversion fair value gap. Sometimes the bodies will be a bit looser. Maybe the probability of the price action is not super clean. Maybe there's no high impact news that day or something, and it can be a little bit looser. The body can color a little bit outside the fair value gap. You want the inversion fair value gap to be closed above strongly. That doesn't mean it has to close all the way up here. Even if it closed up here, that's a good sign because it shows intent behind why price is moving. It's trading and displacing, more importantly, displacing above what was a SIBI and making it an inversion fair value gap, effectively reversing its role. Now this is a form of change in state of delivery. It isn't one because that has a different definition we'll cover in a moment, but it acts like one. So when we go from bearish market structure, where we're putting in lower lows, and we flip that, we reverse into bullish market structure, this will always be there. As long as there's a SIBI to the left side of the curve, this will be there. Now, if you're coming out of a consolidation, it's harder. You want to pair these with liquidity sweeps, which is what the black belt is. So this model is already completely laid out for you. There's nothing more contextual that you need other than here's a high time frame, here's the pattern, because the black belt, it is a pattern. It takes out the pre-market low at 3 key times. One of these 3 minutes, and that's not subjective, it's completely objective, it's completely definable criteria. Is it bullish once it's done that? Because if it is, it's going to go quick, and that's the move you want to be on board with. So here's the inversion fair value gap, displaces higher, and it creates a first presented fair value gap, but before we can even trade down into it, there's a pre-market high. Really fast move, really fast. Also, do not be tricked. My entry, although it says 24,820, although it's at this low, it's at 24,820. That's about up here, this green line. So it looks like, oh, I got the complete low. I didn't. I was in waiting for this fair value gap to become an inversion fair value gap. And by the time it did, price is up there. But I knew because of how strongly it was displacing, the SMT with the ES, the hourly bias, I could take a really, really easy one-to-one trade going into pre-market high, stop loss below this gap. Really nice, a little bit more than one-to-one, but that's high probability stuff. And that's with the support of not just the black belt, but the high time frame, because the black belt can be catalyst for a high time frame move. Okay, one other thing you can use for confirming reversals is a market structure shift. Now with the market structure shift, you'll hear ICT say if it closes one, or not closes, but if it trades through the market structure shift and it closes below it, it's a valid market structure shift. That is true, but those are not the reactions you want to see. You want to see it close through the market structure shift. Those are the strongest ones. If it closes through the market structure shift, and if you've been to the silver bullet mentorship, you'll already know this, those will be the highest performing, where we just displace right to our objective. Now, in a black belt, if you're waiting around for a closure above a market structure shift, that may leave you late to an entry. It may. So you have to look at, okay, which one of these two, market structure shift or inversion fair value gap, makes more sense, where if we invert it, it confirms the idea that we should trade up into the pre-market high, but it also gives me enough range to work with where I can get in and I'm not having to use a massive stop loss all the way to this low. How do we do that? Well, which one's nearer? Which one's more significant? Which one is the higher resistance one. So if a market structure shift is in an area where it's really high resistance, like here, because there's a lot of back and forth trading, if it closes above that, isn't it very, very likely, with everything else in mind, that's all narrative by the way, that if it's closed above that, this should be light work for it, because it's low resistance, high, 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 high. It's like a trend line, and the pre-market high. So if it's done that, that's a super good confirmation, along with the inversion fair value gap, that we're very likely to trade up into the pre-market high. Then once that happens, it goes also into the hourly intermediate term high over here, and then it gives you that sell-off move. Okay, the third little reversal signature we'll go through is change in state of delivery. Now, I went through this in Silver Bullet Mentorship. I don't believe change state of deliveries are going to be the better of the reversal signatures. There's too many of them that if you cannot accurately distinguish between which one is higher probability or not, it's not going to work for you. So you need to look at, okay, not just which of the two recent Dankless candles get traded above. It's not as simple as that. What is the nearest one isn't necessarily going to be the highest probability one. What's the furthest one isn't necessarily going to be the highest probability one. Which order block, which is what two Dankless candles is, when it's formed, tells me it's going to break off from this range and just take off. Is it this one? Is it this one? Is it this one? There's subjectivity there. Whereas with an inversion fair value gap, you have, here's a SIBI. Is it closed above in a strong way? Yes, okay, then it's going to probably confirm that reversal. Here's a market structure shift. There's only one here that's clean. Other than that, we've got this one that's still not invalid. It's a completely valid one, but this would be the main one that I would use. With a change state of delivery, it's going to be a lot harder to pick it out. So unless you're more experienced with using it, I would opt with a market structure shift and an inversion fair value gap. It's going to be harder for you to use a change state of delivery. It's not that these don't work, and it's not that they're not an amazing tool, because they're amazing. And the function of an inversion fair value gap is the same as the function of a change state of delivery. But, with that being said, these are harder to pick out the higher probability ones. But what makes the higher probability ones? When a change state of delivery has displacement through it, just like a market structure shift, just like an inversion fair value gap, that is a good change state of delivery, especially if that displacement is a fair value gap. Because what is a change state of delivery? It's the creation of an order block. When we see two down close candles and then you see an up close candle go through it, that changes the state of delivery from sell side to buy side. Because you're reversing the function of what a down close candle could typically do, you effectively, and when you displace through that, this is now a bullish order block. And then the displacement after it, what is that? That's a fair value gap. What do we know about order blocks followed by fair value gaps? That order block becomes a lot stronger. And it doesn't even need to return to it to run. So that's what happens here. Change to delivery, displacement, becomes a fair value gap, runs. There's our pre-market high immediately taken. Now with the change state delivery, whilst they can help with market structure confirmations, it may be harder to enter on it because generally, well, depending on what follows the change state delivery, it may not retrace into that. And that's the same with a market structure shift, and it's the same with an inversion fair value gap. The best performing or the best times price is going to be when it just runs through them and it doesn't even want to retrace into them. How do you enter on those? Well, I went through this in the end of the last video, similar to how you have a breakaway gap. When you see it close above, you can enter on one contract. When you see it trade back down into it, you can enter the next on there. Now in this case, because it traded above so strongly, I didn't want to see it even go back to that inversion fair value gap. I thought, okay, this is enough where it could be a breakaway gap. It should just take out the pre-market high as it did. So I entered one around this area. I closed it right here. Easy, 1R, beautiful, buy setup. Okay, another key signature that you will always need to use in reversals is the V-shaped reversal. Now, it's just like a V for Velric. When you see this in price, there's no actual V, so this, it doesn't look like a V itself. It does look like a V, but it's not a clean one like this. You want to see, essentially, it's a recovery after a sell side move, but you want it to be fast. So when it takes out sell side, liquidity, does it recover in a fast way where it kind of looks like a V? Here it does. Now that can be helpful because if you see it, do this, that's more likely to lead to a run higher than if it had consolidated around this low and it spent a lot of time down here. That indicates it's going to do some more work. But if it's immediate, like this is, where it takes out sell side, yeah, it does some damage lower, but it doesn't spend a lot of time here. It's only 3 minutes. It's wickiness. It's not a lot of solid-bodied small candle consolidations. It's a recovery. Takes out sell side, immediately recovers. A reversal. That's always going to be there in the highest probability fast-moving reversals. It's always going to be there. It doesn't miss. That's just how the market operates. Just like every market structure shift is going to be a breaker block or a mitigation block. Every reversal has one of those, breaker or mitigation. Every reversal also has, well, every fast, high probability displacement reversal will have one of these. These are the ones that you really want to be on side with. If I see this, I'm more likely to get in, and I'm more likely to get in with higher leverage. Now you couple this with either of the above tools, change state delivery, market structure shift, inversion fair value gap, first presented fair value gap, the opening range gap quadrant being rejected, the hourly BISI being traded into, and then rejecting the pre-market low as well being the black bell model. You combine all of that together and now you have a good enough and deep tool bag to identify strength and weakness when we're looking at reversals. Now, the whole idea behind strength and weakness is how is it delivering price in what I'm expecting it to do. So if I'm expecting, here's a black bell model, I'm expecting it to reverse. How is it going to deliver that idea? The move you want to be in is the one where it immediately rejects sell side or any discount array where we're in a high time frame array. If there's an S&T, even better, it's rejecting the the upper quadrant of that opening range gap. There's a lot of sell side damage and then quick recoveries. There's that V-shaped reversal, there's that inversion fair value gap, strong market structure shift, strong closure above, and then after all of that narrative comes into place, the idea of strength and weakness is how it delivered. So it did everything in alignment with how we want it to be. We want a nice V-shaped recovery. We want it to reject this quadrant from the opening range gap because it's a premium gap. We don't want to see it trade down into this. We want to see it run up. So we want to reject that quadrant. We want to see it strongly close above an inversion fair value gap. We want to see it strongly close up above 830. We want to see it strongly close up above the market structure shift. We want to see all of that because that indicates it's strong. It wants to run higher. It's going to rip there and it's not even going to give you a chance to enter if you're not quick. Those are the trades that you want to be in because they're zero drawdown, they're fast, they're rapid, and that's what this model takes advantage of. But you need to know how to identify those entries, those reversal signatures, and the strength and weakness. Okay, that is going to conclude this episode. I think it was a very insightful one, and it's probably the missing piece for most of you, where I've had the, not complaint, but some feedback on how I'm teaching the model, and I need to teach reversals. This was always in the plan. I've got the entire lesson structure already planned out. I know what I'm going to be teaching in the next few episodes. I'm not doing it spontaneously or on the fly. So trust me, you're in good hands. I've taught a lot of stuff before. So, yeah. Thank you for listening. Goodbye, and I'll see you in lecture number 7. Goodbye.